$600 billion.
Mm-hmm.
I was looking at the capital expenditure projections for big tech in 2026, and that number, it just jumped off the page at me.
Just an absolutely staggering figure.
600 billion. I mean, that's basically the GDP of a mid-sized European nation.
Right.
But instead of running a country, all that money is just being poured into data centers, into concrete and silicon.
It really is. We are watching an infrastructure build out that, it rivals the electrification of the U.S. or maybe the first fiber optic backbone in the late 90s. But the sheer density of this spend is it's unprecedented.
It feels like an all-out arms race.
Yeah.
You've got the hyperscalers, Amazon, Google, Meta, Microsoft. They're all shoving their chips into the pot.
They are.
But here's the thing that I think a lot of people, even some tech analysts, might be missing.
Mm-hmm.
The assumption is usually pretty linear, right? If your capex goes up 50%,
Then your compute capacity goes up 50%. Yeah, that's the classic intuitive leap.
exactly, you assume that all that money is just buying more stuff?
But in this specific cycle, that logic is, it's starting to break down. The central idea we're really digging into today is that the link between spending and actual capacity, it's decoupled.
Right, because we're hitting physical walls. We're hitting supply chain ones.
Exactly. There's kind of a dirty secret hidden in these budget reports. A huge chunk of that $600 billion, it isn't actually buying more servers or more capacity.
Oh.
It's just paying for more expensive parts. It's inflation, plain and simple, and it's being driven by a very, very specific bottleneck.
So we're basically looking at a scarcity tax on AI infrastructure.
That is the perfect way to put it. A scarcity tax. And while big tech giants are the ones footing the bill for that tax, there's one company sitting on the other side of the table just collecting it.
And that brings us to our mission for this deep dive. We're going to unpack this $500 billion poker game. We need to understand the specific component shortage that's jacking up the price. And spoiler alert, it's not the GPUs this time. And then we'll look at the financials of the company that's found itself in, well, the golden position of having the only lemonade stand in the desert.
It's a fascinating setup. I mean, it completely inverts the power dynamic we usually see between the tech giants and their suppliers.
Okay, so let's start with the scale of this spend, just to really contextualize the pressure that's on the supply chain. In 2025, we're looking at an estimated, $360 billion across the major players?
Which is already a historic high. I mean, that number alone is wild.
But then 2026 rolls around, and the projection just spikes to nearly $600 billion. That is a massive year-over-year jump. And when you break it down by company, the numbers, they get even crazier. Amazon alone is planning to spend $200 billion.
$200 billion. And you have to remember, for a company like Amazon, that isn't just AWS servers. Some of that is for their logistics network, sure, but the growth in that number, that's almost entirely driven by their AI infrastructure needs. They are terrified of losing cloud dominance to Microsoft.
Oh, absolutely. And Alphabet, Google, is right behind them. They're budgeting $175 billion.
Well, they have to. They've got to defend search. They have Gemini to train. I mean, for them, the stakes are literally existential.
Totally. If Google loses the AI interface war, they lose the ad revenue engine that fuels everything.
Precisely. So spending $175 billion, it actually feels like the safe option for them compared to, becoming irrelevant.
Then you have Meta at $115 billion, pushing their whole open source model. And Microsoft, their fiscal calendar is a little different, but the early estimates still put them near $98 billion.
So altogether, you have 4 companies just committed to spending an amount of capital that is, it's almost incomprehensible. And they're all chasing the same limited resources: land, power, which is a whole other deep dive in itself, and critically, the silicon.
And this is where the math gets a little weird. Like you said, data center spending is set to go up by about 67%. As an investor, if I see a company boosting capex by that much, I expect their ability to generate revenue to go up by a similar amount. But you're saying that's not what's happening.
It's definitely not what's happening. The efficiency of that capital is dropping like a rock because the cost of the components themselves is just skyrocketing.
Okay, let's reveal the culprit then. Usually when we talk about AI bottlenecks, everyone's first thought is NVIDIA and GPUs. Is that what's going on here?
Well, NVIDIA is certainly taking a huge slice of the pie, but the new inflation driver, the piece of the puzzle that's seeing the most dramatic price jump right now, is memory.
Memory.
Specifically, high bandwidth memory, or HBM, along with high performance DRAM and enterprise NAND.
Okay, so we're not talking about these standard DDR4 sticks you pop into your home PC.
Oh, far from it. This is all about what's called the memory wall. In modern AI systems, the GPU, the brain of the operation, has gotten so incredibly fast that it ends up spending a lot of time just idle, just waiting for data to show up.
So the bottleneck isn't processing speed anymore. It's
Yeah.
getting the data to the processor.
You got it. It's memory bandwidth. To solve this, the industry created HBM. So instead of having your memory chips spread out on a motherboard, HBM literally stacks DRAM dies vertically, like a tiny silicon skyscraper, and places them right next to the GPU on the same package.
So it's as much a physics and packaging problem as it is a chip-making problem.
It is incredibly difficult to manufacture. You're connecting these stacked layers with thousands of microscopic vertical tunnels, they're called, through silicon vias. The heat it generates is a nightmare to manage. The alignment has to be absolutely perfect.
Which I'm guessing means the yields, the number of good chips you get per wafer, are a lot lower than for standard memory.
Much lower. And because making these complex stacks eats up so much factory capacity, the supply of just regular DRAM goes down, which then pushes up prices for everything.
Which brings us to the statistic from the research that it blew my mind. The analysis suggests that as much as 45% of the entire increase in data center spending in 2026 can be attributed just to memory price inflation.
It's a stunning number. I mean, just think about the implications of that for a second. Nearly half of the growth in their budgets just evaporates into price hikes. They're not getting 45% more compute power.
Wow.
They're just paying 45% more to keep the lights on and keep their AI training runs going.
It's that scarcity tax. It reminds me of the used car market during the pandemic. You weren't paying 10 grand over sticker because the car was better. You paid it because it was the only car on the lot.
That is the exact dynamic. But in this case, the car is absolutely essential for the future of these trillion-dollar companies. They can't just choose not to buy it. If they don't buy the HBM, their very expensive NVIDIA GPUs are basically useless. They're just fancy paperweights without memory to feed them.
And this isn't a problem that gets solved quickly, right? We all know how long it takes to build a new fab.
It's a multi-year cycle. Building the clean room, installing the incredibly expensive lithography machines, dialing in the yield on a complex 12-layer HBM stack, you are looking at 2 years, minimum. The experts are all predicting this shortage, and the pricing power that comes with it will last well into 2027.
So this tax is here to stay for a while.
Which is, terrible news for Amazon and Google's margins, but it is incredible news for the companies that are actually selling the memory.
Okay, let's pivot to that. Let's talk about the beneficiary. We've set up the crime scene, these massively inflated capex budgets. Now let's see who's walking away with the bag of money. And the clear winner emerging here is Micron Technology.
Ticker symbol MU. Now, Micron has historically been seen as just a commodity player. You buy memory when it's cheap, you sell it when it's expensive. It was a classic cycle trade. But HBM has fundamentally changed that story from commodity to specialty tech.
Because they're one of only a few players. Who is it? SK Hynix and Samsung are the others, who can actually build this stuff at scale.
And right now, Micron is just executing incredibly well. If you look at their fiscal 2026 Q1 results, the leverage they have is it's undeniable.
I saw the headlines. The numbers were strong. Revenue hit a record $13.6 billion, up 57% from the year before. But in this business, revenue is vanity, profit is sanity.
And the sanity is definitely there. Earnings per share, or EPS, hit $4.78.
And that's up how much?
It's up 167% year over year.
Wow. So that's the operating leverage kicking in. Revenue's up a bit over 50%, but earnings are up over 160%.
That's it exactly. When you have a high fixed cost business like making semiconductors, once you cover your costs, every extra dollar you get from a price increase flows almost straight to the bottom line.
And we saw that in their gross margins too, didn't we? They soared to 56%.
An increase of 1,760 basis points. I mean, for a hardware company to expand its margins by nearly 18 percentage points in a single year, it's almost unheard of. It just screams total pricing power. It means customers are calling Micron and saying, name your price, just please get me my allocation.
It is a seller's market for sure.
Yeah.
What about cash flow?
Operating cash flow jumped 160% to $8.41 billion. They are just printing cash, which of course they can then reinvest into that expensive capex we talked about to try and build more supply.
Okay, but the market is always looking ahead. Q1 was fantastic, but is this the peak?
Well, Micron management certainly doesn't think so. They went on record saying they expect industry supply to remain substantially short of demand, and their guidance for Q2, it backs that up very aggressively,
I saw that projection. They're guiding for, what, $18.7 billion in revenue for Q2?
which would be a 132% year-over-year increase. But look at the earnings. Look at the EPS guidance. They're projecting earnings will jump to $8.42 a share.
Wait, hold on. They just did $4.78, and they're guiding to $8.42 the very next quarter.
A 440% year-over-year increase. It shows that the pricing curve is still getting steeper. As these tech giants get more and more desperate to bring their AI clusters online through 2026, they are bidding up the price of the limited HBM supply. Micron is basically capturing all the value of the AI boom without taking on the risk of actually building the AI models themselves.
It's the classic picks and shovels play during a gold rush, but this time the shovel is made of solid gold, and there are only 3 blacksmiths in the entire world who know how to make it.
And Micron seems to be gaining market share too, particularly with their HBM3E product, which is getting great reviews for power efficiency. That kind of technical lead lets them command an even higher premium.
So investors are looking at this and seeing a stock trading at what, around 38 times earnings? Now, traditionally for a memory company that is very expensive, these stocks usually trade at like 8 to 12 times earnings because of that cyclical risk.
And that's the tension right there. The bulls, they're arguing, look, this time is different. They're saying HBM is a long-term growth story, not a cyclical one. And if your earnings are growing at 440%, then a 38 times multiple is actually cheap. It's growth at a reasonable price.
But the bears, and frankly all of history, would be screaming, watch out for the cliff.
We have to talk about the risks. The memory industry is notorious for what they call the hog cycle. High prices lead to overinvestment in new factories. Eventually, all that new capacity comes online, usually right as demand starts to soften, and then prices just collapse.
Yeah.
We saw it in 2018. We saw it again in 2022. It is brutal.
The inventory correction.
Yeah.
Yeah, that phrase still sends a shiver down the spine of any semiconductor investor.
It should. The vulnerability for Micron right now is that this entire super cycle, it all depends on the hyperscalers continuing to spend $600 billion a year.
So if Amazon or Google wakes up one morning and says, you know what, we haven't quite figured out how to make money from these AI models yet, let's pause the data center build out for 6 months, what happens then?
The air just rushes out of the balloon instantly. Memory, at its core, is still a spot market commodity. If demand drops just 5% below supply, prices don't fall 5%. They can fall 30, 40, 50%. And that amazing operating leverage that's boosting their earnings now, it works in reverse on the way down.
And because Micron is trading at that premium multiple, the stock would probably get crushed. It's a double whammy. Your earnings fall, and the multiple people are willing to pay for those earnings also contracts.
That is the risk. You are betting that this AI arms race is a marathon and not a sprint. If it turns out to be a sprint and the runners are getting tired, Micron is in deep, deep trouble.
But looking at those 2026 budgets, that $600 billion, it doesn't look like they're getting tired just yet.
Not yet. The fear of missing out, the fear that if they stop spending, a competitor will achieve AGI or lock up the market first, it's just too strong. It's a classic prisoner's dilemma. They all have to keep spending.
Okay, so let's synthesize this for everyone listening. We've got a historic, massive capital injection happening in the tech sector, but a huge piece of that money is just getting eaten up by component inflation, specifically in high-performance memory.
Right. The key insight for you is to look past that headline capex number. Spending more does not necessarily mean innovating more right now. A lot of it just means paying more.
And for an investor, it suggests that while the hyperscalers are kind of killing their own margins to compete with each other, the upstream suppliers like Micron are having a once-in-a-generation profit boom.
Correct. But it does require being vigilant. You have to watch the spot prices for DRAM. You have to watch the lead times from the manufacturers. As soon as those numbers start to soften, the party might be winding down.
Which leads me to a final thought, looking at that timeline we discussed. We know it takes about 2 years to build these new fabs. We're rushing to build all this new capacity now in 2026 to fix this shortage.
Which means a flood of new supply is going to hit the market somewhere around 2027 or 2028.
So here's the question I want to leave everyone with. By the time that massive wave of new memory supply finally arrives in 2027 to bring prices back down to earth, will the AI demand still be there to consume all of it?
That is the multi-billion-dollar question, isn't it?
Are we building a manufacturing engine for a permanent new era of computing? Or are we building it for a bubble that might have already burst by the time they cut the ribbon on the factory?
History would suggest we usually build the capacity right in time for the bust, but, if AI really is the next industrial revolution, then maybe the demand is practically infinite.
A terrifying and exciting gamble. Thanks for walking through all of these numbers with us.
Always a pleasure to get into the details.